Hello everybody, this is Daniel with Daniel's Bullion Coins, and I'd like to do a video today on the whiteboard that we have right here, talking about staying in the stock market and riding out the losses. That is a big comment that I hear on YouTube, and people are saying right now, if it's friends or family and I ask them, well, what do you think? Well, I'm just going to ride out the losses. Well, I want to talk a bit about the 1929 stock market crash and the inevitable depression that we went into. And I think we're in a depression right now. The only reason you don't agree with that is because the government is printing money and sending it out to people to cover up the fact that we are in a depression right now. And what we're about to go into is much worse than a depression. But let's start out by talking about the stock market, and we're just going to graph something here and see how it goes. So here we are, and we're coming out of World War I. We were coming out of World War I, and we had the Roaring 20s, and the stock market did a lot of cyclical ups and downs, but generally here it is climbing. We've all heard about the Roaring 20s from after World War I. And then we had the, everybody's heard of the 1929 October crash that we had. It was a flash crash where the market went straight down all in one day. Now, we haven't had a scenario like that here in this market, but I think we would have from 2008. I'm going to put 2008. The market started to crash similar to 1929. But what happened is in 2008, we came in and we were able to stop it right here. And I'm going to just use a different pen to keep things separate. So right here, hypothetically, if this was a 08 crash, we stopped it right there by printing money. But they didn't have that option in 1929, and the stock market went down. Well, what happened was the stock market recovered. And the next year, 1930, they actually came almost back to the high that they had in 1929. They almost recovered. Almost got back to that stock market level right there, whatever that dollar amount was. Hypothetically, right there. But this was a bear market rally. That's what's called a bear market rally. The market is going down, but it rallies a little bit and it takes out a lot more people. People get back in, they invest more into it. They've already lost a lot of money, but they don't want to miss out on the next leg up. They think they're going to see the same kind of leg again. Same thing that we have right now. We have in 2000, this is 2022, we are having a bull rally in a bear market, I believe. This is just my opinion. It's just information to entertain you, and you can do with it what you want, but seek counsel for legal advice on investing. So 2022 is right here. And I believe we're going to start doing exactly what we did in 1929. We're going to do the cyclical drop from there. And it, right in here somewhere is 1933. That's when they really started to reach the bottom of the economic collapse right there. This is when FDR took the gold standard off of the currency. He confiscated the gold and changed the value of it so that then he could start investing in the market. Sort of the same thing that we did here, but printing money. We were able to stop it earlier, but he didn't get involved until 1933 with the gold confiscation and the revaluation. So then there was a lot of investing into the market, and we started to see the market climb again. And it reached that same dollar numerical amount in approximately 1954. It reached that value again. So if you waited 25 plus years, you could be back to where the market was. And that's what I'm saying right now. We have this hyper extended, and you can see this hyper extended by P&E, price per earning. All of these ratios are out of whack. You can study this thing in depth, and there's hundreds and hundreds of ways to compare what we're doing right now with what was done back in the 20s, where stocks are being overvalued. It's the greater fool mentality. You buy it today and sell it to somebody else tomorrow for more than you paid for it. That is the scenario that we're in right now, where the market has risen up to this 2008 point. And we actually, when we rebounded, in 2022, we rebounded much higher than 08, but we're not going to get into that right now. We're using the October 29 Great Depression scenario for right now. And okay, so it was 25 plus years. Not very many investors have 25 years. If you're 50 years old, you'd be 75 by the time you could get your money out. So if you're 60, you'd be 85. That's the timing is too far. It's too many years to have to wait to get your money back out. You want to sell when it's high and buy when it's low down here. The other scenario I wanted to tell you about is in dollar amounts. We're talking about the nominal value they equaled, but 75% the dollar devalued. So in the 20s, right here, you could buy a Chevy car. Sorry, my V is a mess. You could buy a Chevy car right there. I believe it was about $400 or $500. You can fact check me on this. But by the time you got to 1955, if you wanted a Tri-5 Chevy, a 55, 56, or 57, you were going to pay 175% of the nominal value. So dollars that you had here, if you waited 25 years and took them out, that would be the 100%. You would need another 75% to equal the value of a Chevrolet, a Tri-5 Chevy, or a Chevy sedan back in the 20s. New car. Looking at the new car price. So you would have to wait another 17, 18, maybe 20 years for this to continue to climb to where you would be able to see the dollar amount increase 75%. And keep in mind that you wait 5 years, that 75 changes to 77. You wait 8 years, it's 80%. You see, the longer you're going, you're adding more time to it. So really, you would have to wait another 25 years. You'd be 50 years because of the nominal value of the dollar. What this dollar would buy you in the 20s compared to when the nominal value of it is going to equal again. So let's say you're 20 years old and you put $500 in the market. It goes to zero. The $500 comes back in 1955. Well, you can't buy a Chevrolet with $500. So you have to continue to see the market go up to where you can pull your money. If you pulled the $500 out, of course it would have increased. It wouldn't have bought the Chevrolet. You'd have to wait until it increased another 75% to be able to purchase an equal value Chevrolet to an equal value Chevrolet. So this is for the people who say that I'm going to get out when the market comes back up. I'm just going to ride out the highs and the lows, because they saw the '08 low. When we had the '08 low, it was 6,000. We reached 6,000. Well, here in 2022, we reached 34, almost 34,000. And people think that we could have a hiccup or whatever, but it'll come right back, the 34,000. Well, it's studying the price per earnings, it's studying history and how history is repeating itself with the values of the market and the greater fool mentality and all these things. We could spend many videos just on this one area, on why and how it increased and how we're doing the same thing again. We've hockey sticked, increased the nominal value of the stock market. It looks like a high number, it looks like you're making money, but what can you purchase with it? You're really actually losing. That was one thing I wanted to talk about. The second thing I wanted to talk about tonight is an interesting thing that my son brought up, Nathan. He mentioned the other day about how nickel was more valuable than silver during the World War II. And we just recently had an interesting phenomenon, maybe a few months ago, where nickel shot up to 300, 400% in value. The value of it shot up 400% overnight. And it created quite a melee in the global markets. So I started to think about that and realized that during war, nickel and copper are worth way more than gold and silver. You can see how with the 1943 penny, we took the copper out of the 1943 penny and we made them steel pennies. They made millions of them, millions and millions of them, because they needed currency. But you can see how important the copper is. And you can see how important the nickel is, because they took the nickel out of your nickel, your 5-cent nickel piece, the one back then that had the Indian head and the buffalo on the back. Now we have Monticello and Washington on the nickel. Jefferson nickel and Monticello on the back. And the nickel doesn't have nickel in it anymore. I believe it was 2014 we took the nickel out of the Jefferson nickel. So people who say, I don't have any money, I can't do what you're saying, I can't understand it, you can be collecting copper pennies right out of circulation. 1982, halfway through 1982, back to 1959, those are called memorial pennies, and they're right in circulation, and they're copper. And the Jefferson nickels, you can get those for a nickel right out of circulation. That nickel is currently worth about 15 cents, and that penny is worth about 3 cents right now. And I remember when we had the '08 collapse and the crisis of '08, people were stealing the copper off of the gutters, off of buildings downtown, and they were stealing air conditioning units from people's houses just to get the copper off of the air conditioning unit. So copper and nickel were finding their monetary value, not their commodity value. Right now we have a commodity-based gold and silver and copper and nickel, but I believe it's going to go back to a monetary base where it's going to count for its value as money, and then it'll be really valuable. So those of you that are each week you're just barely getting by, get a few nickels, grab a few pennies, sort them out, save them. Doesn't take very long to start getting a pile of them, as long as you're doing it every week with consistency. That was an interesting thought that we had, and I thought I'd pass it along with one of the little secrets to prepping. Thank you so much for watching. Look forward to seeing you in the next video.